Welcome to Something More with Chris Boyd. Chris Boyd is a certified financial planner practitioner and senior vice president financial advisor at Wealth Enhancement Group, one of the nation's largest registered investment advisors. We call it Something More because we'd like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients on Cape Cod and across the country. Here's your host, J. Christopher Boyd.
Welcome, everybody. Thanks for being with us. I'm Chris Boyd, and I'm here with Jeff Perry. We're co-hosting today, and our guest, we are very happy to have Nicholas Paul, CFA. He is a portfolio manager with MFS. And Nick, I enjoyed hearing your presentation at the Morningstar Investor Conference over the summer, I guess it was now. Yeah. But you started making some points that I thought, this is really worth talking about. You're making the case for international in a way that's a little different than what we've heard in the past. And quite often over the last many years, we've heard international is a little cheaper. And that was, that's true, but it hasn't always worked out to be a better option for how to invest. Not that it's an either or decision, but so we wanted to have you have a chance to share some of the insights as to why might be a good time to reconsider to what extent you're going to do some international investing. So with that, welcome first. Thanks for being here. And let's start talking about this. You've kind of made the point in some of your writings and in that presentation that starting point matters. What do you mean by that?
Yeah, so Chris and Jeff, nice to be with you, and Chris, appreciate the kind words in terms of the presentation that
that's really good
that you saw within Chicago, and that idea is really just this idea of starting points matter. And what I mean by that is where we're starting from. I think most of us would agree the starting point today, as we look out over the next 10 or 15 years, the world's going to look incredibly different than it's looked over the last 10 or 15 years. So where we're starting from today, I think is important to sort of put that in context and then sort of make an investment case for non-U.S. equities around that starting point. And I always start these conversations, and I'm sure I started it the same way in Chicago, was, just to take a step back and sort of, the way that I think about non-U.S. equities and what, I'd like to talk about here. First and foremost, I'm not here to pound the table on, now's the time to buy U.S. equities. It's a screaming buy. It's cheap. Trust me, it'll work, which hasn't worked for the last 10 or.
You might have heard this occasionally.
Yeah. I always say, look, cheap is not an investment thesis. There has to be more there. You can't buy something that's cheap because, as we've all seen, especially in non-U.S. equities, it can stay cheap for a long period of time. So this is not, come here and pound the table for non-U.S. equities. And I have no incentive to come here and sell anything. One of the nice things about being an investor at MFS is we do not get paid on assets under management. Our job is to go out and deliver performance for our clients and to collaborate with our other investors in the investment department at MFS. So zero agenda. And to your point, Chris, it's not an either or proposition. Right. This presentation that I put together is really just the case for diversification. I would think of it less as the case for international and non-U.S. and just think about it as the case for diversification. So just to kind of jump back and also to recognize too, as we're coming to you today, it's November 7th. Obviously, we've had a big change in this country and globally from a political landscape now that the outcome of the election is clear. And maybe at the end, we'll kind of come back to that and talk a little bit about what's changed.
How so? Okay. Implications.
Equities. So this idea of starting points matter. So the whole idea is that, again, the next 10 years is likely to look very, very different from the last 10 years. So think about where we came from. And when I say the last decade, last 15 years, really just think post the global financial crisis to where we find ourselves today. Mm-hmm. So coming out of the global financial crisis, it was a world of zero inflation, zero interest rates, in some cases negative interest rates. That is completely behind us. We are not going back to a world of zero inflation and zero interest rates anytime soon, if ever again. So from a starting point today, whether it's fiscal policy, whether it's monetary policy, whether it's inflation, or whether it's interest rates, what we witnessed over the last 10 or 15 years, the starting point today is incredibly different. And the next 10 to 15 years is likely to look much more different going forward. It was also a world that was dominated by themes like globalization, right? Mm-hmm. Clearly, given the outcome of the recent election, you could be in the deglobalization camp quite easily, increasing trade barriers, just in case supply chains. Perhaps that's much more reflationary than deflationary, like we witnessed in a world of globalization. But more importantly, the last 10 or 15 years was really just the perfect storm for U.S. equities. And what I mean by that is U.S. equities are dominated by technology companies, the best in the world, no question about that. But they tend to be technology companies, by definition, tend to be more growth companies. And growth as an asset class tends to be a longer duration asset class. So again, in a world of zero inflation, zero interest rates, you want to add duration. So you want to add growth, you want to add long duration. You're able to look out 5 or 6 years and look for long-term earnings growth. And as you discount that back at low rates, that tends to be quite an attractive investment opportunity, particularly for growth stocks. It was also the perfect storm in terms of these technology companies benefited from tremendous spending on OpEx. So think about the digital transformation, the transition businesses were going through as they transitioned to the cloud. On top of that, you had the pandemic, the whole stay-at-home trade. So it was just this perfect storm that was set up very, very nicely for U.S. equities. And I'm not saying that's not the case going forward. That there will be spending on technology and artificial intelligence going further. And that's why this is not an either-or proposition. But I guess getting back to the point is that I do believe that as we look out over the next 10 to 15 years, where investment is likely to be made, because this is the investment thesis. It's not just buy something because it's cheap. Earnings drive stock prices. So there has to be something more.
Can we go through that a little bit looking forward? Just you ticked off a whole bunch of things. And just that makes the case why things work so well. Let's just go through some of those looking ahead and how that might suggest differently. Fiscal policy. I mean, we've got these crazy debts. And is that something we only look at the U.S. as we talk about this, or are we talking about this in other parts of the world as well when we think about fiscal policy as it might impact investment thesis?
Well, yeah, I think that the U.S. is not alone in terms of elevated balance sheets, clearly. So I think fiscal policy is going to play a role.
Will we change directions in the next 10 to 15 years?
I'm not sure. I'm not sure that that's necessarily the case, but I do think what you will see over the next 10 to 15 years is more disciplined spending. So we came out of the pandemic with well, perhaps time will tell.
The bar is not really high for that.
But coming out of the pandemic and the global financial crisis, right? You had record stimulus, you had quantitative easing.
Right.
We're not going back to that world. Do deficits come substantially lower? Do they go modestly higher? I'll leave that to the economists. But what we're not going to do is likely go back to a world of sort of these record stimulus just in
the zero rate environment. And
exactly.
All that's gone.
And yes, exactly. Particularly in light of current inflation trends.
Globalization, you talked about that notion that we've had sort of over the last 30 years, maybe prior to the first Trump administration and sort of even still, we still have a huge amount of globalization, foreign trade and production done in all other parts of the world and so forth, and the benefits that come with that free trade of lower prices oftentimes. Do we see that as a directional shift that's going to continue, to that deglobalization you think is more likely? And
Yeah,
how does that play into the international investment thought process?
Yeah, I think you bring up a good point, Chris. I do think that this trend towards deglobalization will continue. And again, given the recent election results and the impacts that tariffs are likely to have, certainly you could view the new administration as much more protectionist. But at the end of the day, we're not isolationists, right? So you're still going to have to do business on a global scale. So there will still be some level of globalization. And what you're more likely to see than not is things like nearshoring or friendshoring, so a redistribution of supply chains globally,
right.
Which create very interesting opportunities. So whether that's bringing supply chains perhaps out of China into more friendly nations in Southeast Asia, whether it's bringing things closer to home for the U.S. and Mexico. But this is not this sort of nearshoring to shore up supply chains is not just happening in the U.S. This is happening globally. So if you do the homework and you look, you can find many companies out there, whether they're European companies or Asian companies, that should benefit from these trends. Granted, a lot of this is going to be driven by what's happening within the U.S., but there's plenty of companies out there. Not just there's U.S. companies that will benefit from this trend of nearshoring and friendshoring, but there's many companies across the globe that will benefit from similar trends.
So one of the things that's been interesting over the last several months, we've kind of become heightened awareness of the concentration in where returns are coming from, where the emphasis of some of these AI type names and so forth in the cap weighting of the U.S. index. How does this play into some of the things you think about when you're thinking about the thought process of U.S. versus, or I'm saying versus, I know that's not the right way to position this, but U.S. and international investing?
Yeah, great question. And I think this kind of gets to the core of my whole sort of presentation around starting points matter and the opportunity in international equities. And again, this is the case for diversification, right? And what I mean by that, and I think what you mean by that, Chris, is that today it's essentially, let's call it 9 stocks are driving most client portfolios, right? It's the Mag 7 and it's Broadcom and it's Eli Lilly for the most part. That's what's going to drive, for better or for worse, and it's been a great investment. That's what's going to drive client portfolios today. Now, if you went back in time, what I think is interesting is if you looked at performance international versus the U.S., that relative performance will always ebb and flow, right? The market always rotates, right? Whether it's sectors or factors or industries. But the last time we saw non-U.S. outperform the U.S. for a sustained period of time was sort of this period between 2000 and 2008, right? So think just post the dot-com era, and this will lead into your question on concentration. Sorry, I'm being long-winded, but think post dot-com era up until the global financial crisis. And the world's very different today, but are there some parallels that we could draw between that 8-year period and where we find ourselves today? Number one, over that 8-year period, inflation averaged 4.5%, or sorry, 10-year treasuries averaged 4.5%, global inflation averaged 3.5%. So think sort of 1% real rates. Sounds a lot like where we are today.
Yep. Those sound similar, yeah.
Yep. Why does that matter? Here's why that matters. Non-U.S. equities tend to be more value. You think about, and this is the same argument for growth versus value. So U.S. is growth because of the concentration in tech. Non-U.S. is more of a value asset class. And in an environment of higher rates and higher inflation, it's a more cyclical, shorter duration asset class, and they tend to do a bit better with some healthy inflation and higher interest rates. So that's one similarity. The other is you'd have to go back to the dot-com era to find valuations as attractive as an entry point to where we find ourselves today.
Yeah.
So that's the second. But here, to your point, The third is market concentration and concentration risk. Again, you would have to go back to the .com era to find concentration levels anywhere close to what we're seeing today. And I'm not saying that Amazon or NVIDIA or Microsoft are the eToys or the Pets.com right, of the early 2000s, but concentration risk is significant. And one more similarity, because this is really, really important. So over that eight-year period, call it 2000 up until 2008, if you looked at the S&P 500, its annualized return over that 8-year period was 1.7%. So it was a very low return environment. The annualized return for non-US was a little over 7%. So non-US was up about 74%. The S&P was up about 14%. So that low return environment is also something I think investors should potentially focus on. It's not that Amazon or NVIDIA or Microsoft are going out of business, but you've had such euphoria around spending on generative AI. If that were to pull back just a bit and earnings were to flatten just a bit and multiples were to derate just a bit, there's such big concentrations of the benchmark. You could easily see yourself in a low return environment. And that's why Goldman just came out about 3 weeks ago. I don't know if you guys saw the research report, but their 10-year expectations, long-term expectations for the S&P is 3% annualized over the next 10 years. What do they point to? They point to starting valuation. They point to corporate profitability, because profitability today for U.S. is at all-time highs. They point to interest rates, so a lot of what we just talked about, and they point to market concentration as the big driver of this. So in a world where S&P is returning 13%, 60% annualized, why diversify? But in a world where you have lower returns, diversification is going to be a big benefit.
Talk about for a minute, if you would, with regard to that diversification of sector exposure. Where do you tend to think in terms of emphasis when you look at an international exposure? I mean, and maybe this is the case for talking in a particularly as a portfolio manager, talking about the differences between managed and indexed. But it might be worth just having some emphasis on that. And then tied to that maybe is cash flow, income, dividend, that people might see a difference in sometimes when they think about international investing, as it may have a significant difference in how they receive their performance.
Yeah, that's another really good question, Chris. So let me sort of come at it this way in terms of the opportunities around individual names and sectors and industries. And so if you look at the Mag 7 weight in the S&P 500, today it's about 30% roughly. 30%. So a third of the S&P 500 is driven by 7 stocks. So let's compare that, as you mentioned, to non-US. So if you look at the all country world, so that's non-US, including emerging markets, the all country world ex-US, a lot is made about the so-called granolas, right? And so companies like ASML and Nestle and Novartis, Novo Nordisk is obviously done very well with GLP-1s. But if you look at to get to 30% in non-US benchmarks, a 30% weighting, you would have to take all the granolas plus another close to 50 companies.
Wow.
Right. So the opportunity, so it's much less concentrated. It's much less concentrated from a sector standpoint. You're going to get more exposure to, again, value places, value sectors of the market, more exposure to financials, more exposure to energy companies, more exposure to materials. But it's just a much more diversified starting point for us as we look for opportunities as active managers. When the benchmark's that concentrated, that becomes a little bit more challenging. But outside of the U.S., just given the sheer number of names out there and the significantly less concentration, and it's well diversified across sectors and industries. Think U.S. is tech, and non-U.S. is kind of everything else in a lot of ways.
Okay. And is there a difference in dividend kind of? That's not
sorry.
we focus on. We tend to focus on total return, but is that I have the impression that investors who are looking for income tend to get more income from international investing.
Yeah, absolutely. I mean, typically, if you look at dividends, particularly in Europe versus the U.S., they tend to be quite a bit higher than you'll find within the U.S. So, thinking about it in terms of total return and thinking about it in terms of, maybe where to pick up a little bit of income from your equity allocation,
Yeah,
it
for
makes
those
a lot of
who are
sense as
looking for that.
well.
How about the thought process of you referenced the all country world index and if did I do that right? ACWI, right? Yeah.
Mhm.
So what about management in
Mhm.
that thought process? Some time. I mean, I always think it's important to keep reminding people there are times when management really adds value,
Yeah.
and I just would love to have you have the chance to speak to that briefly.
Yeah, I think maybe Chris, where I would sort of tie that into is some of the opportunities that you're seeing in Japan today for
Let's talk about that.
yeah, for example. So we've been finding a lot of opportunities in Japan, and what's been driving a lot of that is, and this isn't actually that recent. You'd have to go back to 2012, sort of the start of Abenomics in terms of trying to incentivize Japanese companies to be better, to do a better job of returning value to shareholders. And what I mean by that is, historically, if you look at Japanese companies, they've tended to have very low price to book ratios and very low return on equities. And a lot of this was driven by their hesitation to return capital to shareholders through things like buybacks. And also, Japanese companies traditionally have had a lot of cross holdings, so owning other companies and businesses outside of their core business, and that's gone back in Japan for probably close to 100 years. And it tends to so there's a lot of value there if they were to sell off these businesses, these cross holdings. If they were to divest from these cross holdings, you could unlock a lot of value for shareholders. And in 2023, the Tokyo Stock Exchange came out and implemented a process where now they're requiring companies that are trading below book value or with poor returns on equities to start to come up with capital improvement plans. And they're really starting to call these companies out. And you have seen some progress there. So we have seen an increase in divestments of cross shareholdings. By some calculations, even if you just look year to date, share buybacks in Japan already exceed 14 trillion yen, which is significantly higher than all of last year, which came in about 10 trillion. So you are starting to see some benefits here. But long-winded way of saying, capital allocation, good corporate stewardship, good management teams is hugely important for the investments that we make, and investments that I think investors should look at. There's a lot of ways to drive earnings and profitability and return value to shareholders. You could do it through valuation improvement, profit margin improvement, generating better earnings growth, or again, simply doing a better job of returning capital through buybacks, or unlocking value through divesting cross holdings like we're seeing in Japan.
Very interesting. I was looking at some Japan ETFs, these are U.S. funds that were ETFs that invest in Japan. And it was interesting, the dramatic difference in performance for hedged and not hedged. Talk a little bit about currency and outlook for that, and how should investors think in terms of this issue of how to think in terms of the U.S. dollar's impact on foreign investment, and how should they position hedged, unhedged? A little bit.
Yeah, good
about this.
Good question. I'll shy away a little bit from how they should do it, but I'll talk about
the
certainly
implications, maybe. Yeah.
So I think as we talked about at the beginning, we kind of made the base case for why international equities, and then with the caveat of, obviously, the landscape's changed pretty dramatically in the last couple of days as the election results have now become clear. What's not entirely clear, it is clear that tariffs are going to be a big part of the administration's global economic policy. But what does that ultimately mean for inflation and interest rates? And then what does that ultimately mean for currencies? So one of the headwinds, to your point, Chris, that U.S. domiciled or dollar domiciled investors investing in non-U.S. equities have had for the last 15 years has been dollar strength. So the dollar's at a multi-decade high. That was, so as we sit here today, and the dollar's really strengthened. Well, it strengthened a lot yesterday after the election results came out, and it really started strengthening again since kind of end of September, early October. But what happens there, the reason that that's such a headwind for dollar-denominated investors is as you take those non-U.S. currencies and you translate them back to the U.S. as the U.S. dollar appreciates, those currencies depreciate, so they're worth less.
So you might have had a great return in a European stock, but when you translate that into dollars, it loses some of that value, that performance by virtue of that
100%. 100%. So what I would say is if your outlook is for a stronger dollar, then you'd be better off hedging out some of that non-dollar currency risk. If your outlook is for ultimately a weaker dollar, you'd be better served to take on that currency risk, because the opposite happens. If the dollar's weakening, you're taking on a stronger currency that's going to help your return profile. So the big unknown is, what do tariffs look like, right? It's anywhere from 20 to 60% on China. They're clearly in the crosshairs. For everybody else, it could be, we've kind of heard the number of a broad 10% tariffs thrown out there, but that's going to vary by country. It's going to vary by sector. So you don't know. But what you do know is that inherently tariffs are probably, probably inflationary. So potentially you could see, and then the market reacted to that, right? I mean, if you look at 10-year treasuries a couple months ago, they were at 3.5%. Today they're at 4.5%. So the market's reacting to the fact that there's going to be the pro-growth approach by the new administration is likely to be somewhat inflationary. Again, time will tell. But if inflation interest rates go up, you could easily make the case that the dollar is going to appreciate as it tracks foreign currency to those higher interest rates. But again, we have to kind of wait and see how all that plays out. The other side of that coin is non-U.S. central banks. They'll probably see less inflation, but tariffs may potentially lower growth, so they might be more aggressive in cutting interest rates and stimulating growth. So there's a lot of trade-offs you have to deal with. But I mean, directionally, if you think that the dollar is going higher from here, you'd be better off hedging out that currency risk. If you think it's going lower from here, you'd be better assuming that currency risk. But again, starting points matter. We're already at a multi-decade high for the dollar.
That was right where I was going to go.
How much higher is it going, right?
Yeah, that was where you have had that theme of starting points matter. I was really curious. So if you had a thesis on this, or one that you care to share, that kind of mindset, the idea that, there's reasons you could argue for either side of this, but you sound like you're thinking, well, there's the mindset right now, the dollar's pretty high.
It's exactly so. The way that I try to hit it right down the middle, to stay in my lane, is I say, look, dollar's at a multi-decade high. Chris, Jeff, you guys can give me 3 or 4 reasons it's going higher. Probably give me 3 or 4 reasons why it's going lower. If it went lower, that'd be great for a non-U.S. investor, a dollar-denominated non-U.S. investor. But I don't even need that. I just need to stop going up. If it just goes sideways from here, now we're on a level playing field from a currency standpoint. I think, longer term, sort of sideways to maybe, directionally a bit lower. Again, there's a lot of unknowns out there. I think is, just given from where we're starting is probably sort of the base case.
Nick, is there anything in the election landscape that makes you change any of your thoughts of where you were before the election?
It doesn't, other than the fact that there will certainly be implications from a policy standpoint on certain countries and ultimately certain sectors. So think about the automobile sector, right? That again is sort of in the crosshairs of the new administration. And that's, whether you're selling EVs out of China, or you're selling, traditional, combustion engines or EVs out of Germany. That's clearly an area that you're going to want to pay attention to. So I would say it hasn't changed anything in the sense that I am a big believer that diversification is going to be very, very important. We're at concentration levels in the U.S., which has been great. These are great companies, don't get me wrong, but we're at concentration levels in the U.S. that we've really never seen before. And ultimately, there's going to be a crack there, and I don't know when that happens. And
Sure.
But when it does, not if, but when it does, that diversification benefit is going to play out. So just make sure at the end of the day, whatever you're diversifying through, in this case, non-U.S. equities, that you're just buying. You know what you own at the end of the day. You want to know what you own. You want to buy good companies. I can find you I can find you great companies in the U.S. I can find you really great companies all over the world. Earnings drive stock prices. That's where your focus should be. And if you do that over time, nothing for me really has changed, other than you have to be more selective, maybe today versus even just 3 days ago. But the benefits of diversification to me haven't changed.
Did you? We're keeping you a little longer than planned. I don't know if you have time, but do you want to talk at all about emerging markets? That was one of the things we thought we might get to talk about. Any passing comments as it relates to that?
I guess the only passing comments there would be that we talked about the impact of the dollar. That's amplified when you start to look at emerging markets. So emerging markets historically have been had a very high inverse correlation to the dollar. So as the dollar strengthens, that tends to be a big headwind for emerging markets. As the dollar weakens, that's a huge tailwind for emerging markets. So a lot of it depends on your view of emerging markets. Yes, and the thing I would say is just, again, you got to be very, very selective. I'll use China as an example. They're certainly in the crosshairs as it relates to tariffs and exports, but there's a lot of national champions in China, whether it's beverage companies or food companies, that are going to be somewhat isolated from some of the economic policies of the new administration. But I also do think you got to think down geopolitical lines as well, right? And those emerging market countries and economies that are more aligned with the West and Western powers are likely to have more access to technology and capital flow, and those that are on the other side of that are probably going to be shut out in a lot of ways. So again, it really just comes down to, particularly outside the U.S., I think, a bit of a plug for active management.
Yeah, I was just going to say the same. This would be a good example. Yeah,
it all sounds like it leads back to that.
Yeah, at the end of the day, you really need to know what you own. You can't just buy the market. In a lot of ways in the U.S., again, 7 stocks drives your portfolio. That's not the case outside the U.S. So really, know what you own. Don't just buy the market.
Nick, thanks so much for taking the time. Nick Paul of MFS. Mick, do you want to mention any of the ways people can follow you and learn more of your views, or to identify funds you might be involved with?
Oh, I try to keep a bit of a low profile, so don't worry about trying to find me. But MFS, I guess I'll give a little plug there. We just celebrated our 100-year anniversary. For those who don't know MFS, we've been around since 1924. We actually
the original mutual fund, right?
First mutual fund in the United States, the Massachusetts Investors Trust. So we just celebrated our 100th birthday.
That's nice.
And even one of the strategies I work on, the International Diversification Fund, was one of the industry's first non-U.S. fund of funds. It's made up of 6 underlying strategies. And we just celebrated our 20-year anniversary on that. So that's all the promotion I have in me, and I'll leave it there, and I'll leave it to others to do the promoting.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's for financial planning or portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at somethingmorewithchrisboyd.com or call us toll-free at 866-771-8901. Or send us your questions to amr-info@wealthenhancement.com. You're listening to Something More with Chris Boyd Financial Talk Show. Wealth Enhancement Advisory Services and J. Christopher Boyd provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is general financial comments and cannot be relied upon as pertaining to your specific situation. Wealth Enhancement Group cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.